It's my pleasure to introduce our 2016 inductee into the Bergstrom Real Estate Center Hall of Fame, Mr. James Heistand. This award is bestowed on individuals whose lifetime of service has shaped the real estate industry in a significant way. There are few who meet this definition better than Jim. Jim grew up in Miami, where he graduated from high school in 1970, and then moved on and attended the University of Florida, where he graduated in 1974 in business with a major in real estate and urban analysis. Jim has always been involved with office properties and rose through the ranks as a regional manager for Carnegie Properties. He then was president of Major Development Corporation, which was a subsidiary of Major Realty. In 1989, Jim started his rise as an entrepreneur. He founded Associated Capital Properties, where he spent almost 10 years building a portfolio of 6.5 million square feet of office space, which he sold to Highwood Properties. In 1999, Jim moved to Dasco, an owner and operator of medical office buildings. Under Jim's leadership, Dasco acquired or developed 1.4 million square feet of space that he sold to CNL Retirement in 2004. Prior to the sale of Dasco, Jim started Eola Capital in 2000. At Eola, Jim and his team acquired $1.3 billion in assets, totaling over 13 million square feet. In 2011, after filing to take Eola Capital public, Jim led the company in a merger with Parkway Properties. At Parkway, Jim has led a resurgence in the company with new strategies and capital. Since becoming the firm's president and CEO, Parkway's market cap has increased from $200 million to more than $2 billion. Parkway has also generated a 100% return to the shareholders over that same period of time. In addition to the great success in business, Jim is very involved in his community and in education. He has donated to and been active on the board of numerous charities in the Orlando area, and has also been a major contributor to St. Jude Children's Hospital. In partnership with the Central Florida chapter of NAIOP, Jim established an eminent scholar chair in real estate at the University of Central Florida, and he is a founding member of the Chairman's Circle of the Bergstrom Center for Real Estate Studies at the University of Florida. I might add, he also set up a scholarship at the University of Florida in the name of his mother. Jim Heistand is an incredible person, husband, father, businessman, and Floridian. We are honored to call him a Gator and now a member of the Real Estate Center's Hall of Fame. So please join me in honoring Jim Heistand.
Wow, that seemed like a lot of work listening to it. If I got to use these notes, that means I'm in trouble. Firstly, I'm honored and grateful. I was hoping I could get up here like George Perez and say thanks to the Academy, and then get off the stage, but I'm not George Perez. But I do, I've been asked to say a few words about some of the experiences I've had, which I'm happy to do. But before I do, I want to thank my family for coming. my wife Jennifer, my son Richard, my son Bolden, my daughter Lauren, Catherine Rees, who was one of my first employees at ACP, Catherine, and Roger Caserta, who him and I grew up together in Miami and came all the way for today, so thank you guys, I appreciate it. You know, as I thought about what I might talk about, my wife was suggesting I talk about something a little bit more relevant to the younger people, and you know, I don't know a thing about technology other than it will continue to change real estate without a doubt, and in a variety of different ways. But I thought I'd talk about some things that I think are relevant no matter how big the iPhone or how small the iPhone or all the technology changes that occur. And so I'm happy to do that and share some of that. I don't usually do that. I always told my kids that don't talk about what you're going to do or what you've done. You just go ahead and do it. And so now I thought I'd give you some background as to how I got from A to Z. You know, when I think about it, one of the things that was most important to me was getting the degree from the university. From the university, for me, I was the first person in my family to get a degree, and it kind of, for me, gave me a safety net to take on what I wanted. You know, I was looking for financial success, and that's got a lot of risk associated with it. And I always felt that by having that degree, no matter what happened, I could always get a job to pay the rent, even if I didn't like that job, right? So I'm going to kind of take you back to how I kind of started and walk through the mindset that I had to start my own company. If you go back to '87, as Kelly mentioned, Major Realty. Major Realty owned all of the property where Universal now sits. The intention was to have the same development there that was at the Millennium Mall site. There was no interchange in the Millennium Mall site, so they brought me on to create reoccurring income for the company because their business plan to date was to sell off land to cover overhead. All right, that was their plan. And as you know, certainly in business school, that you ultimately eat the pie up. There's nothing left, right? So they were looking to get reoccurring income. I came in. At the same time that I came in, and my job was to find income properties, begin to develop the property. But simultaneous to that, they had a hostile takeover bid from a group out of Detroit who coveted that land that Universal now sits. So for 18 months, the company got embroiled in a hostile takeover. So I'm witness to all of these things that are going on, and I thought, you know, I can do better than this. And so, but while I was there, you know, I was the president of a company. I had at that time a very large salary for me, stock options, a Lincoln Continental with the phone in the floor and the big antenna, saying I was a big time guy now, and I thought I would hit the jackpot. And they also gave me credit cards because when you're public, all of your comp is put in your proxy statements. Everybody knows what you make. So they started sending me all these credit cards, 10 of them, each with $10,000 limits back then. So I kept all those. And then ultimately, the hostile takeover bid was forced to do a tender offer, which they did, but he was short on his financing. And so he was, financing raw land, very difficult. I had bought 2 buildings then, Eola Park Center and a small building off of Kirkman. And so I was able to, with a good old friend of mine who's passed away, Jim Jamal, he found Middle Eastern investors for me. And I was able to come back to the buyer and bridge his financing gap with those 2 sales simultaneous to closing. And with those, I was able to start my first company, ACP, which was just me, Catherine, and 2 other people. We had no ownership in them, and I couldn't pay myself a salary, but it was a start. And I think having that degree is what gave me the courage to go do that. And so what I thought I would do is talk about, oh, by the way, 4 years later, Major Realty, and my father-in-law thought you're crazy, you go on your own, you have this big salary. I could have stayed there, great company, publicly traded. 4 years later, they went bankrupt, filed Chapter 7, not reorg, Chapter 7 liquidation, and then I was fortunate enough in '97 to sell my company to Highwoods for $617 million. So the risk paid off. But I think The point that I want to make to that is there's lots of risk. You can't get away from that finance 101 class, risk return. And if you're looking for outside risk, gains, you're going to have outside risk. And I was able to take them because I had that degree. I always felt no matter what, I can get a job. So I thought that I would kind of go from there to talk about, I started 4 companies. The first one was the hardest, and I learned the most. And I kind of want to walk through a handful of things, and then I'm going to get off the stage as to things that I thought were important, things that I learned, and I think things that are relevant no matter, what the time or technology. When I started off, we had no money, so I was constantly in New York and Boston looking to raise money. And so, when you're out making pitches, whether it's a product, yourself, no matter a building, you've got to sell, right? But you've got to watch your audience. Too many times I've seen people where they're giving presentations or talking, but they're not paying attention to the people across from them. And you can tell, after a while, I got to be able to tell whether or not somebody was buying what I'm selling. They didn't always, and at the beginning, most of them weren't buying it. But when I could tell they weren't going to buy it, I would say, listen, it doesn't fit your parameters. Next time, before he told me no, if I find something that works, next time I'm up here, I'll show it to you. So at least I could walk out of there with some dignity, and at least he thought I had options, right? Every once in a while, somebody would say, well, wait a minute, I didn't say I wasn't interested, I just had a few more questions. And then at least I felt I had some leverage at that point, right? So, I've dealt with a lot of smart people, some of them don't watch their audience. And along those meetings and for years that I did, I met a gentleman, Marty Rabinowitz with Odyssey Partners. He was in his mid-70s. And I was up there pitching. We had 3 buildings tied up in Miami. I was pitching. And he listens, and he goes, son, seems like you know what you're doing. Seems like good deals, but let me give you some advice. You're going to come to New York. You got to think bigger. You can easier to raise $100 million than it is $10 million. And he was right. A next very important component that I learned is you got to think long term. Somebody once told me, if you think long term, it's amazing how quickly the results come, right? I know it's counterintuitive, but especially in our business, all these people here I've known for years, it's people move from place to place, but if they're in the same business, they'll know how you conducted yourself, good or bad, when you're doing a deal, okay? And it's much more efficient to deal with the same people over and over again. You'll make more money in the long term, and it'll happen much quicker than you try to take that last dollar off the table and then, move on and burn bridges. Don't do that, and I'll give you a tangible example of that. When I sold ACP to Highwoods, Lehman Brothers was probably 70% of my equity. And the way it worked is, here's a price for all of it. I've got to negotiate with my partners for what their pro rata share is. Of course, everybody thinks their share is worth more. What's left is mine and my partners. So they were going to take us public. And they had done a lot of work. Investment banking team did a lot of work for us, spent a lot of time, a lot of hours. And we didn't have any contractual arrangement to pay them their investment banking fee because Morgan Stanley brought us the deal, which was $5 million. And so we paid them anyway, all right? Had no reason to. But as a result of that payment, I did 43 JVs with Lehman over 15 years. I've made up far more than that money that I would have taken off the table. And at that time, we had already negotiated, so that was all our money. That wasn't the partner's money. So think long term, and it'll pay you dividends. I think surround yourself with good people. I've always tried to have people around me who are smarter than me. If we're honest with ourselves, we know the things we're good at, what we're not good at. We're not always honest with ourselves. The hardest part is to admit what you're not good at. I love that Clint Eastwood song line, a man's got to know his limitations. Well, you got to know what you're not good at to bring in the right people around you. And I've been very fortunate and built very good teams. And if you bring in the right people, you want people who've got options, and then you got to reward them for it too. Because if you want to grow that pie bigger, you'll still get more, but you got to be able to divvy it up and give them you want the kind of people who have options, and the only way they'll stay is if you reward them. So make sure you get good people. Ego. You got to keep that in check. I mean, I think if I'm honest, I think to myself, the mistakes I've made, and I've made plenty, it's been largely ego-related. Decisions I made, I won't go into details, but plenty of them. So keep it in check. You know, I know it's hard to do, but I've got some old partners, people I knew in this business who were exceptionally bright, did an amazing job. Ego got in the way, and they did not make it through the last recession. So I'd keep that in check. And I think probably the last thing I'll leave you with is try something you've never done before. I think about when I was kind of climbing that corporate ladder to get to be president of Major Realty, I'd always tell people, they'd ask me, have you done this? I'd say, yeah, sure, I've done it. I never had did it. And especially in a big company, by the way. Most large companies, people don't want to make mistakes, but if you want to outperform, we're back to, you got to take more risk. So I would take it on and then try my best to go figure it out. So, you know, try things you haven't done. I've always felt if I wasn't doing something I hadn't done, I'm not growing anymore, and I'd like to continue to grow. Bless you. And so, you know, none of us really know what we're capable of. We just don't. Until you're put in those situations where you don't have much choice, right? When the consequences are dire, it's amazing what you can do. It really is. I mean, I think I'll be free to admit, when I took over this role, when I first did the merger with Parkway, they were a small company, bad markets, bad assets, but they overpaid for us, so we had to do the deal. And I came in as chairman, and so I wasn't going to be dealing with the investors or the analysts or the marketplace, and so, you know, it was not a bad gig at the beginning. But within 90 days, the CEO resigned. They asked me to take it over, and I will tell you, I was a nervous wreck. I mean, I have to do this, but I have to do this with a very hostile environment on many occasions of investors and analysts. Not hostile, but, you know, they're probing constantly. And so I was nervous. Never did that. Ran my own companies for 25 years. Now I got to be in a public format. I was scared to death. But we did it. We turned it around. And so, you know, I think the thing is, it's amazing what you can do. It really is. And I'm hopeful here in 5 years I'm going to be doing something else again besides this. 5 more years of this, I would be able to handle it. But, you know, so hopefully what I've kind of talked about is relevant no matter what situation, especially those who want to be an entrepreneur and try it on their own. You know, I've just been more of a risk taker than most. You know, by the way, I don't know whether you all did your due diligence on this, but I was on academic probation my first year at the University of Florida. Dr. Archer, I don't know whether you actually did the work on that. We spent far more time in the study hall, not studying, but playing poker and drinking beer. But I will tell you, you learn a lot playing poker, okay? So, so with that full disclosure, hopefully I'm still inducted. And with that, again, you know, I am so thankful. Thank you all.